Hello everybody, my name is Jason Marshall with Marshall Insurance and Financial Solutions, and today I'm just going to talk about the basics of life insurance, because if you're anything like me, I really didn't know too much about it outside of maybe I had a little policy through my job, but it's a lot more that goes into it. So I just want to spend a couple of minutes with you to show you the different types of life insurance so that you'll be more educated when it's time for you to make that decision, which should be soon, by the way. All right, so it's only two types of life insurance, okay? So let's just delve into the first one. So we got term insurance. Now, term insurance, this is a very popular type of life insurance. Now, what makes it so popular, Jason? Well, what makes it popular is that it allows you to get a large amount of life insurance for a pretty low premium. And so I liken a term policy similar to renting a house or an apartment. So you have it for a certain length of time, and once that time is up, it's either time to move on to something more permanent or renew your lease and stay longer. And so let's just take a look at how this term policy works. So some of the I help most of my clients with a term that has what they call a level premium. Now, what a level premium is that you're going to pay the same monthly bill every single month for your life insurance. So let me show you how it works. So say, for instance, if it was a family and they wanted to get life insurance. So typically, they say their kids will be grown and on their own in 20 years. So what I do is I help them get a policy, and the way that it works is they pay the same monthly premium for 20 years. And what happens is in year 21 is when it's going to start to, let's see here, it's going to start to go up and up and up and up, and to the point where it's no longer affordable. And so the thing is, while term is good, after that time or that temporary length of time, it's going to start going up to the point where you no longer can afford it. But here's the name of the game. Most of the term policies that are out there, and all of the term policies that I help my clients with, are what they call upgradable. So you can upgrade it. So the name of the game is, before you get to the end of your term, it's time to upgrade to the second type of life insurance, which is called permanent. Now, permanent is extremely popular. Another term you may hear for permanent is whole life insurance or cash value life insurance, and the list can go on and on. But the thing is, it's very popular, and it comes with a lot of different bells and whistles. But of course, with a lot of different bells and whistles comes a higher premium. But here's the thing about the premium. Once you lock in your premium, it's going to stay the same your entire life, so you don't ever have to worry about it going up on you. Okay, and so the best thing to do is to get a whole life policy or a permanent policy while you're young and at good health. Matter of fact, a lot of parents get them for their children when they're babies, and their premiums are dirt cheap. And guess what? As they get older or may have health conditions that come upon them, it doesn't affect the premium at all. So if it's $10 a month when they're a baby, it's going to be $10 a month as they become an adult. So just keep a little note of that. Now, a permanent policy is similar to owning a house. Now, when you own a house and you pay your mortgage every single month, right, you are building what is called equity into your house. Now, the same applies to a permanent policy. As you continue to pay into your permanent policy, you are building equity into your policy, but it's not called equity in the insurance world. It's called cash value. Now, cash value is something that is very, very popular. A lot of people think that life insurance, somebody has to die in order for wealth to be transferred, but actually this has what they call living benefits. And what I mean by living benefits is you can utilize this cash value while you are still alive. And so what makes this so popular is that it is guaranteed to grow. This is money that builds up in the policy, and it's guaranteed to grow. And so the next question most people may have is, how can you guarantee something like this to grow? And I'm glad you asked. So let's just talk about it. So everybody that pays their premium into a permanent policy, those premium dollars go into what is called a general account. Okay. And forgive my handwriting. I'm a lefty, so it may look like I'm a doctor writing a prescription. But anyway, a general account is basically a great big old bank account that most of the larger financial institutions have. And typically the money that is built up in these institutions can be anywhere from upwards to $100+ billion, with a B, not M, but a B. Now what they do is they take this $100 billion or so and they reinvest it into these smart, investments that have proven to perform very well over a long period of time. For example, government bonds, real estate, things that they know are going to perform well. If they don't think something is going to perform well, they're not going to put their money into it. And typically, a lot of them have just like an emergency fund, or an excess of cash that is in the billions of dollars. And so based on that information, they can guarantee that no matter what the economic situation is, they can always be able to put money towards the cash value of your permanent cash value life insurance policy. Now, this is a second way that this cash value policy can grow, and it's through a fancy smancy word called dividends. Okay. Now, dividends is just a fancy way of saying that the company had a successful year and they can share in their profits with you. Now, the only way they can share in their profits with you is if they are what they call a mutually owned life insurance company or a financial institution. Mutually owned simply means that if you own a policy or a product with that company, you actually own a part of the company. So when the company has a good year, they can actually share in the profits with you. It's similar to a credit union. So if you have an account with the credit union, you actually own a part of the credit union. So here's the thing about dividends. Dividends are not guaranteed. It's based solely upon if the financial institution has a successful year. Here's the thing though, one of the financial institutions that I help my clients with, they've been paying dividends for the last 170 years in a row. So we got to let you know that dividends are not guaranteed, but we can also follow that up with we've been paying it for a very, very long time. Now, it's a third way that this can grow, and it's through an acronym called OPP. And I'm not talking about naughty by nature OPP. What I'm talking about is an acronym by the name of Option to Purchase Paid Up Additions. It sounds fancy, it sounds smancy, but what it simply means is, say for instance, if you were to come across some extra money, maybe you get a bonus at work, or you just come across extra money and you want to do something with it. Well, you could take that money and throw it towards the cash value of your policy. And I forgot to put a line here for the dividends when they have a successful year. But you could take that extra money, throw it towards the cash value of the policy, and what happens is it accelerates the growth of the policy. And so now what was down here when you originally got this permanent policy is all the way up here in the cash that's built up into it. And so again, some of the things that, have people or that has created a big popularity about a cash value policy is, number one, it's guaranteed to grow. But a couple other bells and whistles that people may not be aware of is that this money is growing and is guaranteed to grow, but it's not at risk for stock market volatility. And so say, for instance, the stock market crashes or whatever like that, you don't have to worry about your money being lost. Another thing is, if you have money built up in this and you need to access it for whether it be a down payment on a home, a car, helping your kids with graduation or college, you can access this money before the age of 59 and a half, and you will not be penalized. Now, if you try to go into your 401k or your traditional IRA and you go into it before the age of 59 and a half, well, guess what? You will be dinged with a 10% penalty. On top of that, you will have to pay ordinary income tax. So that is something that is beautiful about it. And while we're on the subject of taxes, another thing about it is that the government deems a cash value life insurance policy is a vehicle that when you get ready to pull money out of it, you do not have to pay taxes on it. So it's a very tax beneficial type of place or investment to put your money into. And it's all legal, moral, and ethical. And so I just wanted to show you all the two types of life insurance. And so, if you've been thinking about it, wasn't quite sure which way to go, don't hesitate to reach out to me. I'll be more than happy to be a resource and educate you and see which one is the best fit for you all. And so until next time, ladies and gentlemen, I'm Jason Marshall with Marshall Insurance and Financial Solutions, and you all have a blessed week.